Thank you. Thank you. Well, good morning, everyone. It's good to be back for our 13th. How many of you have been here for 13? Has anyone been here for all 13? A few. Wow, that's impressive. Thank you for coming for all 13. So we have a lot to get to. We're going to talk a lot about what's happening in the world. There is a lot happening in the world right now. A lot of things are in flux at the moment. We're going to try and touch on as much of that as we can. I may throw a Browns joke or two in. As you know, I like to do that. And I may, but I may not. We'll see. But let's get right into it. We have a lot to get to. First of all, a little bit about ISA. If you don't know what ISA is, that's International Strategic Analysis. We are a provider of economic forecasting, country market intelligence, advisory services. We service major companies like McDonald's, Coca-Cola, the NBA, to smaller companies looking to expand into international markets. So if you want to learn more about ISA, please talk to me after the presentation. So what are we going to do today? The structure is a little bit different than in years past, but relatively familiar. We're just going to talk about some of the key issues and trends that are driving the global economy at the moment. And then we're going to go around the world and look at the health of the global economy. Then we're going to go region by region to see just how things are right now for the global economy. And then we have time for some Q&A. So if you have any questions, by all means, feel free to ask me at the end of the presentation. So what are some of the things we're looking at in terms of the global economy? What I want to focus on at the beginning here is there's three key drivers to economic growth. There is trade and investment, a very important driver of economic growth. There is demographics. Simply put, the bigger the population, the more natural economic growth you can have. And then we're going to talk about productivity and why there has not been significant productivity growth in recent years. In fact, we call those the three great disruptions. We've had disruptions to trade and investment in recent years. You know about the US-China trade war. You know about some of the other trade disputes. You know that population is changing dramatically in many of your key markets, and you know that productivity growth has been disappointing. So we're going to touch upon all of those first. So what are some of the key trade and investment trends and issues that we're looking at the moment? Well, global trade, even before the US-China trade war, has been relatively depressed, and I'll show you some statistics in a little bit. We've been in a period now of about 7 or 8 years where global trade and foreign investment has been relatively low, with growth almost non-existent. The US-China trade war, which we're going to talk about in a little more detail, has been highly disruptive for some sectors of the economy and for some economies around the world. It's caused a lot of uncertainty. It's caused a lot of confidence to be knocked down in recent months. And the next big trade issue we're looking at is the potential for bigger trade disputes between the US and Europe. And that's something we're going to be looking at in more detail. We're going to look at some of the factors. Why are we having these trade disputes now? Why is global trade suddenly something so controversial? We're going to look at some of the economies, how they've been impacted by some of these trade troubles, and then we're going to look at foreign investment. Why has foreign investment also been depressed? In recent years, we've seen negative foreign investment growth. We assume we live in a time of globalization with trade growing and investment growing. The fact is, for almost a decade now, that has not been the case. So we're going to look at that in a little more detail. So what you see here on this chart on top is recent global trade growth by year. And then if you look at the bottom, that's global trade growth by decade. And there's a clear trend. Global trade growth has been falling consistently now for the past decade, if not longer. This goes contrary to everything we talked about. When we started doing this here in the late 2000s, we were talking about much higher rates of global trade growth. And we saw global trade consistently growing faster than the global economy. Well, over the past 7 or 8 years, the opposite is true. The global economy has grown substantially faster than global trade has grown. In fact, over the past, over the past 7 years, just 1.6% per year growth in global trade, whereas the global economy during the same period grew by 3.5% during that period. So a substantial change. Suddenly, the global economy is growing faster than global trade. In the outlook, when we look forward, there's not a lot of expectations for faster global trade growth in the years ahead. We'll talk about some of the reasons going forward. First of all, the US-China trade dispute. Now, you know there's been a phase 1 trade deal which has been signed by the US and China. In our view, this is kind of kicking the can down the road. Most of the tariffs that were put in place during the trade war remain in place. And for us, perhaps most contentiously, China is expected to import more than 200 billion additional imports from the United States. Now, China hasn't been importing 200 billion in total imports from the United States at all. So the expectation that suddenly imports, that U.S. exports to China are going to more than double over the next 2 years are quite difficult to believe. And we expect that to cause some problems. Now, that's probably not going to cause any problems this year. But what we're expecting is about 2021, 2022, when the realization comes that China is not importing 200 billion more worth of U.S. imports, we're going to see some additional trade friction here. And in fact, if you look at these charts, and it's a little hard to read, but you do receive the presentation, that dotted line on the top of each of those charts, that shows where, according to this phase one trade deal, U.S. exports to China are supposed to reach. And the other lines show where they would be going under current trends. And you can see there's a huge discrepancy between the two. And for us, this is the big sticking point to this phase one trade deal. It's just, you're just not going to see this happen. Now, yes, you're going to see an increase in U.S. exports, probably in the agricultural sector, probably in the energy sector, and that's going to be simply taking exports from one country. So, for example, soybeans from Brazil may be replaced by soybeans from the United States. So it's going to cause some significant disruptions for other economies, and nevertheless, the chances of China importing so much from the U.S. are slim indeed. So while the U.S.-China trade war is kind of on hold, nothing much has changed at the moment, there is a growing threat of a U.S.-European trade war. Now, we've already seen some shots fired in this trade war. The United States imposed tariffs on European imports because of subsidies going to the aircraft maker Airbus. There's going to be a similar ruling on Boeing this summer, so we could have retaliatory tariffs from Europe. We've seen issues over the steel tariffs here in the United States. There's a lot of pressure now to put tariffs on automotive imports from Europe. So we're seeing the potential for a significant trade dispute between two more large economies. Another issue is the digital tax. I don't know how familiar you are with that. France was planning to implement a tax on large tech companies, most of which are, of course, American. There was an agreement between President Trump and President Macron of France that this tax wouldn't be implemented this year, but there are at least 6 or 7 other European countries that are looking to implement a similar tax. And the U.S. has said clearly any country that implements such a tax will have tariffs put on them. So the potential for significant trade disputes between the U.S. and Europe is substantial in 2020. So why are we seeing this surge in trade disputes? And it's not just the U.S. and China, it's not just the U.S. and Europe. We're seeing many countries around the world engaged in varying types of trade disputes. One key reason, of course, is the loss of manufacturing jobs in developed economies. We've seen that here in Ohio. We see that in many countries around the world. Manufacturing jobs left going to emerging markets and other places, and this has led to a political backlash against trade and against foreign investment. At the same time, we've seen a relative lack of wage growth. Now, wage growth in the United States has picked up over the last 12 to 18 months, but still, it's lagging tremendously behind economic growth and many other growth indicators. So this, again, raising public anger against trade, against the loss of jobs, against the loss of potential wages. This has led to the rise in protectionist policies, both from politicians on the left and politicians on the right. And not just here in the United States, in many parts of the world. Protectionist policies, protect our jobs, protect our industries, are very much in vogue in many parts of the world at the moment. At the same time, we're seeing technological change. You're well aware of this. We've talked many times about the impact of automation on the manufacturing sector. You can bring manufacturing jobs back to Ohio, manufacturing output, excuse me, but you're not going to be bringing the jobs back. These are going to be increasingly automated factories. Another factor is localization. This is a big issue right now around the world. We are seeing a definite trend towards building your products or supplying your services right where your consumers are. This is a trend we've seen growing over the last few years. It's something that is playing a key role in the reduction in trade, the reduction in investment growth, and something we need to watch going forward. And then finally, demographic changes, and we'll talk more about this going forward. This is changing the electorate. We are seeing a more conservative electorate. We are seeing an electorate that is more in favor of protectionism, in some cases nationalism and isolationism, and this is leading to major political changes in many parts of the world. So what countries are at risk from a trade war? Again, you've probably seen this slide, but the United States is less at risk than just about anybody else right now. We only derive about 12% of our economic output from exports. Now that's still a much higher level than it was in the past, but compare that to Germany, which about 46% of their economic output comes from exports. Look at Mexico and Canada, who are heavily dependent upon the U.S. market. So the U.S. is operating from a position of strength when it's launching trade disputes with other countries. In the countries that suffer, and if you look at the economic results of a lot of the countries at the top of this list, it shows that these trade disputes have had a major impact on the health of their economies. Not only is foreign trade slumping, foreign investment is slumping as well. In fact, we've seen negative foreign investment growth since 2012. We saw substantial foreign investment growth start at the bottom in the 1990s and into the 2000s, but foreign investment has barely grown at all over the past decade. And most of that growth came right after the financial crisis. In recent years, there's been no growth at all. For me, this is a sure sign of a lack of business confidence, a lack of investor confidence. That's one part of it. And the other part is, again, localization, this trend towards bringing your production facilities or your service centers closer to your consumers. And we're seeing a lot of that in North America. We're seeing that increasingly in Europe and in parts of Asia. And that is reducing as well foreign investment growth around the world. Talked about the lack of business investor confidence. Another big factor in this slowdown in foreign investment has been changes in monetary policies over the last 5 or 6 years. Early in the decade, a lot of money was flowing into emerging markets. That stopped in about 2014 with changes in monetary policy here in the US and in other major economies. And that has not really changed much since then. Another big factor are lower commodity prices. Simply put, commodity prices are relatively low. You look at the price of oil, for example, over the past year. You think about this for a second. Last year, we had attacks on Saudi oil installations. We almost had a war with the US and Iran. And yet what happened to the price of oil? It's still trending downwards. That shows you just how much downwards pressure there is on the price of oil right now. A lot of that has to do with the fact that the US is now producing so much oil. The US is now the largest oil producer in the world by some margin, a margin that continues to grow. So supplies are not in jeopardy. And at the same time, we're seeing oil demand be relatively weak in recent years, not just in terms of relatively low economic growth, but the fact that we're now seeing a trend away from oil and towards renewables. Many barriers have been enacted by many countries in recent years, claiming that certain industries are strategic and therefore barred to foreign investors. This is another trade and investment barrier that's been going up in recent years. And again, the issues of localization and automation, which I mentioned earlier. So we see one of the 3 key pillars of economic growth, trade and investment, has been relatively weak in recent years. And in fact, the outlook for trade and investment at the moment is quite uncertain. So that's one of the 3 main pillars of economic growth, and it doesn't look that strong at the moment. Another key pillar, of course, is demographics. Population growth drives economic growth. It's that simple. You have more workers, you have more consumers. It sounds quite simple. But what's been happening in recent years and in fact in recent decades? Well, birth rates have been falling tremendously. The replacement rate, if you have no immigration or emigration, if 2.1 babies are born per, 100 women, I think, your population holds steady. Well, almost no major economy in the world today has a birth rate in excess of 2.1. In fact, many have birth rates far below that. China, their birth rate fell to just 1.0 last year. It's the lowest in modern China. We've seen declines here in the United States. We've seen declines everywhere. So the birth rate is falling. It has been falling. And what does that mean? That means that there's the working age population is growing slower. You have more elderly people as a percentage of your population. You have less young people. And now you have a working age population which is starting to decline in many key economies. Here are some examples of that. 2 very well-known examples are Japan and Germany. That chart shows the working age population in red and the non-working age population in blue. And look at what's happened in Japan. Japan is perhaps the most extreme case in the world, but the working age population in Japan has declined by more than 10 million people in the last 20 years. And going forward over the next 50 years, it's going to decline by another 30 million people. Basically, it's going to be cut in half. Japan has one of the lowest birth rates in the world. It has almost no immigration. So Japan, one of the most successful economies in the world right up until the early 1990s, has been hit incredibly hard by the fact that its working age and consuming age population has been in decline for some time. And Japan's economy since 1992 has grown at less than 1% per year. Many of you can remember back in the late 1980s or the beginning of the 1990s, Japan's economy was the envy of the world. It was growing 7 or 8%. Its per capita wealth levels were significantly higher than the United States at that point. Well, it has slumped tremendously over the past 3 decades, and the main reason for that is the fact simply it's disappearing. Japan's population shrinks by a person every minute. So it's shrinking rapidly, and the population shrinking. Germany is another example. Now, Germany had that influx of immigration in 2015, 2016, but nevertheless has one of the lowest birth rates in the world, and we're going to see a significant decline in the working age population there. Now, how does that look in the 2 big economies? Well, in the United States, even though our birth rate has fallen and immigration levels have suddenly fallen, we're still projected to have a working age population that grows a little bit. Now, we're not seeing much growth, and historically, this is not growth at all. And many of you know that when you're trying to find workers for your businesses and you realize there's nobody out there, it's very hard to fill positions. It is the #1 issue that I hear from our clients now in the United States and in many other parts of the world is we just cannot find employees anymore. It's becoming incredibly difficult. So imagine in the United States where our working age population is still growing and we can't find them here, what it's like in many other economies. And perhaps the most interesting one is China. Now, as you know, in China, they've had a one-child policy in place since the 1970s. That was lifted a couple of years ago, but nevertheless, the birth rate in China continues to fall. The working age population in China is peaking right now. It's peaking at about 920 million people. And over the coming decades, it's going to fall tremendously. And this is one of the major issues facing the global economy going forward. Here, this economy accounts for more than almost 1/3 of global economic growth, China. And in the coming decades, its population, its working age population, is going to fall dramatically and very quickly. I mean, we're talking about a loss of 100 million working age people in the next 20 years. That is substantial. And this is a country that doesn't have the social welfare systems and the retirement systems that wealthier countries have in place. So how is China going to deal with the fact that its tax-paying base is going to be shrinking while its retirement age population is going to be soaring? It's going to be a major issue going forward. And just to verify what the impact has been, look at those unemployment rates. Can you imagine, I mean, who could imagine that the US would have an unemployment rate of 3.5% right now, lowest rate since 1969. Japan's unemployment rate just around 2%. Germany is just above 3%. All these major economies with unemployment rates that are well below what is considered to be a healthy level. I mean, most economists would suggest that a healthy unemployment rate is somewhere around 5%. And we're all well below that. Many other economies, it would be the same. This is a direct product of these demographic changes we've been talking about. Even here in Ohio, the unemployment rate, 4.2%. That's one of the lowest levels we've ever seen in this state. And again, it's reflected in the inability of companies to find enough employees. So while the working age population is declining, and it's going to decline rapidly in many markets, the over 65 population is soaring. Look what's happened in Japan over the last 20 years. The over 65 population has grown by 14 million, whereas the working age population at the same time declined by over 10 million. So a tremendous increase in the over 65 population. Same thing in Germany. It's growing here in the United States, and most substantially in China. This is the one growth market that I've mentioned in many previous presentations that is guaranteed to be there in the years ahead. It's the over 65 population. Products and services aimed at this market are going to have a fast-growing market available to them. Look at in China, the numbers are staggering. I mean, we're talking about a doubling of the over 65 population over the next 20 years. That is remarkable. And it's something that is going to transform the global economy in the decades ahead. So, of course, what does that mean? We don't have enough workers. The working age population outlook is very poor. That brings up the very controversial issue of migration, of course. Now, the only way for the working age population to grow in North America substantially, certainly in Europe, in some of those East Asian economies, is through migration. But there is very little appetite right now in the world for increased migration. We've seen a lot of resistance to it here in the US. We see it in Europe. How this is managed going forward is going to be an important issue because we still see in the poorest parts of the world substantial population growth. If you look, I talked about the birth rate being just one child per woman in China. In In places in, let's say, in sub-Saharan Africa and some parts of the Middle East, it's still 6 children per woman. So the working age populations in those regions are growing tremendously fast without job creation levels matching them. So are we going to see a big transformation in manufacturing and other industries to those places where the population is growing, or are we going to see an acceleration of the process of automation and technological advancement? That's a big question going forward. So finally, here we have 2 pillars now that don't look that strong. Trade and investment. We're kind of shooting ourselves in the foot because it's not growing, and a lot of that has to do with decisions made by economic and political leaders. Second pillar, demographics, also looking dangerously unstable at the moment because working age populations are set to fall dramatically. So what's the third? Where's the growth going to come from? It's got to come from productivity advancements. Now, productivity measurements are notoriously controversial. There are hundreds of different productivity measurements out there. We'll look at a couple different ones here. The one we have on that chart there is total factor productivity, so that includes capital plus labor. And there you see over the last decade, it's been negative. So all of this promised productivity growth that all these technological changes and process changes were going to bring haven't really resulted in any productivity growth. This is one of the great questions in economics right now, is why is productivity growth so disappointing? We're going to look at a couple of the theories as to why it's been so disappointing. There is no one universal answer. Nobody really agrees upon why, but we'll look at some of the more plausible theories going forward. What are some of them? Well, one, simply put, the technological and process advancements of the last couple decades just haven't really lived up to the hype. I mean, there hasn't been a dramatic advancement such as the car, for example, was 120, 110 years ago, or some other flights, some others really boosted productivity. The recent productivity, recent technological advances really haven't boosted productivity much at all. Another theory is that there are some economies or some businesses within certain industries that are seeing strong productivity growth, but they're being held back by their counterparts in their industry or other economies who are performing poorly. And there is some credence to this. If you look at some tech sectors, we've seen relatively strong productivity growth in IT, for example. But if you look at some other sectors, such as mining, for example, we've seen almost no productivity growth in recent decades. Same holds true for countries. Countries that have a more tech-based economy do have higher rates of productivity growth than those who have been left behind somewhat. Another theory is that rising levels of inequality are resulting in mass segments of the population failing to become more productive. If 50 or 60 years ago, it was easy to go straight from high school, go into a factory, and have a really good job. That is very difficult these days, and that has resulted in certain segments of society losing productivity growth over time. And then finally, one issue that's not disputable is the fact that business investment simply has not been there in the 21st century. Business investment levels are extremely low. They've been extremely low for the past 20 years, and this has had a knock-on effect on productivity going forward. Those charts show these are more labor productivity, but shows productivity growth in the US and Germany. We have the charts for about 20 different countries, but the trend is clear over the longer term. Productivity growth is trending downwards. Now, in the United States, a tech-heavy economy, we saw a surge in productivity growth in the late 1990s, early 2000s, but that has dissipated significantly. In a less tech-heavy economy like Germany, which is more traditional manufacturing, we've seen consistent productivity growth declines over the past few decades. And this is replicated in emerging markets, in other developed economies. We're seeing the same trend over and over. Productivity growth over the long term declining. And this is where we need to grow if the global economy is to continue to grow going forward. So it's a dangerous combination. Trade and investment growth looks to be anemic at best in the coming years. The demographic situation is going to be very challenging for most major economies in the world, and we need to find a way to recharge productivity growth. If we fail with the last one, it's going to be very hard to generate higher levels of economic growth going forward, and that's going to be a big challenge for everybody around the world right now. So what is the state of the world economy right now? Those are nice theoretical things we've talked about, but what do we see in actual figures and actual results? Well, let's have a look. What are some of the key questions for the global economy? Can it bounce back? 2019 was a challenging year. Our prediction for economic growth in 2019 appears to have been dead on, that it would be a slowdown, it wouldn't be a hard landing. If you remember last year, our number one issue, we talked about a downturn in sync, which means that most of the world's largest economies would all grow slower in 2019 than they did in 2018. Well, that came true. 18 of the largest 20 economies in the world will have grown slower last year than they did the year before. The only two that grew faster, does anyone know? Brazil, which came out of a recession, and Japan, which grew by 0.9%, which beat 0.8% the year before. So that's it. Everybody else grew slower. That's like the Browns winning 6 games instead of 5. They went backwards. They won 7 and only won 6. So the Browns also were in the downturn in sync last year. One of the key issues, of course, is are these trade tensions that we just talked about, are they going to persist? And what impact are they going to have on the global economy going ahead? Can the U.S. continue to defy expectations of a slowdown? If you listen to a lot of economists, they've been predicting a sharp slowdown for a couple of years now, and it hasn't come to fruition. The U.S. economy, the first estimate of fourth quarter growth was in line with what we thought. Our estimate for last year's growth was 2.3%. We'll look ahead in a couple slides to see what we predict for the U.S. going forward. Europe is in a slowdown. We'll talk about that. The European numbers that came out this morning were worse than expected, in fact, so we'll talk about that. China and India had very disappointing 2019s. These are considered to be the 2 main growth engines for the global economy, and they both underperformed substantially last year. Political trends, clearly politics is having a bigger impact on the economy than at any time in recent memory. That's likely to continue. And then we will touch upon the controversial subject of the U.S. presidential election in November. So let's move forward. The global economy, we estimate the global economy grew by 2.9% last year. That's the lowest rate of growth since the financial crisis in 2009. Between 2012 and 2018, the economy was remarkably steady, growing between 3.4 and 3.8%. So 2.9 is a substantial decline in growth. Our forecast for 2020 is the same, 2.9%. But if you look overall, if you look at those last 2 charts, the global economy grew so far in the 20th century by almost 4% per year. That's a higher rate of growth than in the 1980s, than in the 1990s. Now, most of that growth came from emerging markets. And when we go forward, our prediction for the entire 2020s is growth of 3.3% per year. So we're looking at global economic growth in the next 10 years that will be significantly lower than it has been over the past 20 years. A lot of that has to do with the fact that many of the key emerging markets that were driving growth are slowing, which is natural as they become wealthier, and the fact that developed economies are still struggling to find growth. So developed economies, so the US, Canada, West Europe, some East Asian economies, Australia, there's a clear trend towards lower growth, and this has been happening for decades. You remember my discussion about if your grandparents had a firm in the 1950s, 60s, and 70s, and they were operating mostly in the US and Europe, the economy was growing by more than 4%. They were lucky. They didn't have to do much. The market was growing. The economy was growing. Then when that company shifted to your parents, in those markets, growth fell to 3% per year in the 1980s and 1990s in developed economies. So growth started to slow. And what's happened over the last 20 years, the developed economies around the world have grown by less than 2% per year, just 1.9% per year. So we've seen a definite trend towards lower growth. And all of those factors we talked about earlier play into that. We've seen demographic declines in most developed economies. We've seen trade and investment move to emerging markets over the last 20 years. And we've seen productivity growth decline. So it's been a very rough time for developed economies. Now, between 2015 and 2018, there was a little bit of a bounce back. We saw healthier rates of growth in a lot of developed economies, but 2019 was a challenging year. And let's get into some of those in more detail. First, the US and Canada. I mentioned the US's results for the fourth quarter. The preliminary ones look pretty good. And that means for the year, it looks like we'll have growth of 2.3%, which is better than most any other developed economy last year. A lot of it now, that has a lot to do with strength in the service sector. I mean, the manufacturing sector right now in the U.S. is in a recession. If you just take the manufacturing sector, it's been a very difficult time for a lot of manufacturers. A lot of this has to do with trade disputes, a very strong dollar, which is impacting exports, and some other factors. But nevertheless, the U.S. economy, thanks to strong consumer spending, thanks to a pretty robust service sector, We managed to grow 2.3% last year. And our forecast going forward is calling for 2% growth in 2020 and 2021. We're still not forecasting a recession. We haven't. A lot of economists over the last 2 years have already forecast that we should be in recession by now. It hasn't happened. And we don't think it will happen over the next, let's say, 18 months for sure. There is some pessimism. The business confidence indexes that we see are very negative right now in the United States. A lot of the businesses we talk to are pessimistic at the moment, but we still expect consumer spending to remain robust. We expect inflation to remain under control. The big issue for us is more long-term. The budget deficit is about to pass $1 trillion again. That's very frightening because it's forecast to go up to $1.3 trillion in the next couple of years. And if you look at the presidential election that's coming up, you have one side saying we're going to cut taxes again. We have the other side saying we're going to boost spending tremendously again, but nobody is talking about how they're going to pay for it. And that's frightening going forward, that neither side in the presidential election is looking at this risk of long-term debt and this rising budget deficit seriously at the moment. As for Canada, sorry, I didn't touch upon Canada. Canada's had a rough couple of years. Commodity prices have been low. The trade disruptions with the United States have weighed heavily on confidence levels in Canada. We are expecting Canada to start to bounce back, particularly in 2021. This is an economy that should be growing in excess of 2% per year, and we expect it to get back there within the next couple of years. I mentioned the presidential election. That's the key issue in the United States going forward. It's very hard to predict at the moment. Now, President Trump's approval ratings have been remarkably steady. They're the lowest of any modern president at 43% on average, but that's not that much lower than Obama or Clinton were at this point, and they both won re-election. In fact, 8 of the last 10 presidents who've run for a second term in office have won. The only 2 that didn't were Carter and George Bush Sr. So he has the power of the incumbency, and we frankly don't know who the Democratic nominee is going to be at the moment. You have Joe Biden, who is the presumptive favorite. He's a centrist. He polls very well against President Trump on a national level. But you also have Bernie Sanders and Elizabeth Warren, who are more to the left. They don't poll quite as well in a lot of the Midwestern states that are going to decide this election. Keep in mind, in 2016, there were 9 states decided by less than 2%. President Trump won 7 of them. That's kind of like your football team winning a lot of games on last-second field goals or in overtime. He won 7 out of 9 of the very closely competitive states. Can he do that again? A lot of that's going to have to do with depending upon who the Democrats nominate and what the state of the economy is as we get later into the year. Another big issue for the United States right now is the continued strength of the dollar. If you're an exporter, you've been suffering for this now for 6 years. We're in a cycle of dollar strength that is almost unprecedented. We've had 6 years now where the dollar has been relatively strong against pretty much every other currency in the world. And that chart, okay, it has the British pound twice. I'm not sure why, but if you look over the last 6 years, the US dollar has appreciated against every major currency, and sometimes quite substantially. If you're doing business in Mexico, over the last 6 years, the peso has weakened by 50% against the dollar. If you're doing business in Brazil, obviously, it's very difficult to export right now. So this has been a major challenge for a lot of our clients who are based in the U.S. and exporting around the world. There's a lot of talk that the dollar is due to come down. We don't see that at the moment. As long as risk levels remain high, as long as the U.S. economy remains relatively healthy, which we're forecasting it to do, the dollar is likely to remain strong well into 2021. So you're going to have to deal with a strong currency at least for another year here in the U.S. So the next developed region we'll look at is West Europe. West Europe had recovered to some degree between 2014 and 2018. You had a weak euro, which boosted exports. You had a lot of pent-up demand when all of these crises in Europe took place between 2009 and 2013. There was not a lot of spending going on. That spending came between 2014 and 2018. It's starting to dissipate now. We saw a very difficult year in 2019 for the European economy. The German economy grew by just 0.6%. In 2019, Britain, which we'll talk about in a little bit, had been the key driver of growth in Europe over the last couple decades. It's been struggling because of the Brexit uncertainty. Italy has just basically not grown at all for 20 years. So a lot of these major economies in Europe have been struggling, and as a result, the European economy slowed substantially. And the numbers that just came out this morning for the fourth quarter in Europe were worse than expected. Italy shrank substantially. The Eurozone grew slower than expected, so we've seen very disappointing growth. And if you look ahead, into 2020, 2021, it's very hard to envision significant growth coming out of Europe over the next couple of years. You have uncertain export situation, you have domestic demand that's weakening, so it's going to be a very trying time for the European economy, probably for the next 24 months at least. Of course, today is Brexit Day, the day where the European Union loses the United Kingdom, or the United Kingdom leaves the European Union, depending upon how you look at it. They will be leaving at 6 o'clock p.m., 11 o'clock UK time. I spoke on Wednesday in Cleveland at a conference, and the British American Chamber of Commerce were there, and they are having a Brexit watch party tonight. I'm not sure what they're watching. I don't know if the European Union flag is going to be lowered in London. I really don't know what's going to happen, but they are leaving the European Union tonight, basically. And while they're leaving, there's still a lot of uncertainty that there's no trade agreement yet between the UK and the EU. The British assume they can reach one by the end of this year, but there's no guarantee that's going to happen. The European Union leaders appear to be quite skeptical that can happen, so that trade relationship remains unclear. Now, Britain is trying desperately to reach trade deals with other countries, including the United States. One of the most contentious issues right now is the potential trade deal between the U.S. and the U.K., and the U.S. is driving a very hard bargain at the moment with the British in terms of reaching that trade deal. Now, what does this mean for the European Union? Now, imagine if California left the United States. Maybe some of you would be happy. But this is even bigger than that. I mean, the European Union is losing 24% of its defense budget, 21% of its foreign investment, 15% of its economy, and 13% of its population. This is a substantial loss. London was in many ways Europe's Silicon Valley. It's where investors from the United States and Asia went when they wanted to invest in Europe. It was the center number one for investment across Europe. And now it's not going to be part of the European Union anymore. How that plays out remains to be seen, but it is a very interesting dynamic. Another big issue is just the long-term struggles of Europe's big economies. There are success stories in Europe, but they often come from the smaller economies, places like Sweden or the Netherlands or Ireland. They've been doing very well. They're quite competitive. They're economies that have adapted to the need to compete internationally. Unfortunately for Europe, its big economies haven't really done the same. You look at the lack of growth in Italy, relative lack of growth in Germany. France has struggled for a long time now. These major economies, which have not reformed to deal with the challenges of the 21st century, that has been a big drag on growth across Europe. So the other developed region is the Asia-Pacific region. So we're talking about Japan, Australia, South Korea. It was a relatively challenging 2019. You have economies like South Korea and Australia, which are some of the fastest growing developed economies in the world. They slowed substantially in 2019. There's been Singapore had a very difficult year because it's a trade-dependent economy, so it was hit hard by all of these trade disputes. There are very few success stories in this part of the world in 2019. One thing we'd like to talk about, of course, is Japan. I've already mentioned its demographic situation, and a lot of the rich world needs to look at Japan as a warning. I mean, as I mentioned, in the 1970s, 1980s, right into the early 1990s, Japan was the most successful developed economy in the world, maybe the most successful economy in the world, period. It was growing at rates of 7 or 8% per year. Its per capita GDP levels far surpassed the United States by 1991. But since 1992, the economy's grown by less than 1% per year. It's succumbed to a lot of those factors that we talked about earlier, much earlier than any other economy in the world. And now are we doomed to follow suit? Are we doomed because of our demographic changes, our lack of productivity growth, our inability to compete in some regards in terms of trade and investment? Are we doomed to follow the path that Japan has been on for the last 30 years almost? The other issue I'll mention is the Australian bushfires. You've certainly seen this on the news. This is one of the most dramatic environmental stories of modern times. Those maps there show the equivalent of the areas burned by the bushfires if they were in the UK, US, or Japan. And just look how much territory has been burnt by these bushfires. Now, fortunately, Australia did a very good job of evacuating people. The death toll was relatively small. But this serves as a warning for what's happening. Temperatures are rising. We can debate why they're rising. There's no doubt they're rising, and climate is changing. Last year we were here in a polar vortex. That was a rare occasion. This year we're here, it's 34, 35 degrees. There's not much snow. Where I live, we haven't seen any snow. We had 106 degrees last summer in Luxembourg. That's 30 to 40 degrees above the normal temperature at that time. So things are changing, and how businesses, how governments, how regions are going to adapt to this is going to be very important going forward. So that's the situation in the rich world. What about in emerging markets? Of course, this is where the growth has been coming from. Since 2000, emerging markets have grown by 5.6% per year. That's almost 3 times the rate of developed economies. So clearly, the impetus for global economic growth has shifted from the rich world to emerging markets. Much of that has been in emerging markets in Asia, in China, in India, and in Southeast Asia, a region which has a combined population of almost 3.5 billion people alone, those 3 that I talked about. This has been the key driver of growth going forward. Now, emerging markets haven't been universally successful. Those emerging markets outside of Asia that are dependent upon oil exports or mining exports or just aren't very competitive, they've struggled tremendously in recent years, and we'll get to each of those going forward. The assumption has been, and it's been in place for a long time, that as the world globalized, that the poorer countries would close the wealth gap with the richer countries. That's been the assumption. A lot of economists talked about that at one point in some utopic future, the whole world will be relatively the same level of wealth. Well, that really hasn't happened. In Asia, it's happening. Look at those numbers for China, Indonesia, Thailand. We've seen significant declines in the gap between their wealth levels and the U.S. wealth level. You see there, the U.S. wealth level is 100. You see in 1980, 2000, and today the difference. In China, the wealth gap has closed tremendously. From China's per capita GDP in 1980, just at the start of their economic reforms, was only about 3% of the United States. It was one of the poorest countries on the planet. Today it's 30%. Still relatively poor, but a tremendous, tremendous change. But that hasn't been the case in other parts of the world. Look what's happened in Latin America over the last 40 years. Argentina in 1980 was half as rich as the United States. It was a relatively wealthy country. Today it's down to 30%. Brazil from 40% down to about 25%. So in Asia, we're seeing this wealth gap close, and it's continuing to close substantially. But outside of Asia, not really the case. And this is a big challenge going forward. The assumption has always been in these emerging markets that we will get richer, we will enjoy the fruits of our labors just as they do in the United States or in Europe or in Japan. But that's not happening. We've seen a lot of unrest over the last year. If you've been following the news, you've seen protests across the Middle East, you've seen them in South America. And this is one of the key drivers of that, just the unfulfilled promises of the last couple decades. So let's talk about China. We have a lot to talk about with China. The Chinese economy grew by an official rate of 6.1% last year. That's the lowest rate since 1990, which is, of course, the year after the Tiananmen Square incident. Now, as I've mentioned before, the Chinese numbers need to be taken with a few grains of salt. But nevertheless, for the Chinese government to admit that the economy slowed from 6.8 to 6.1% is an admission that it was a very difficult year last year for the Chinese economy. Exports only grew by, I think it's 0.3% in China last year, so basically no export growth. Of course, with the trade war with the United States, exports to the United States fell substantially. Retail spending, consumer spending in China is still growing, but it's not growing by the double digits that we saw in previous years. It's growing by between 7 and 8% right now. So the Chinese economy continues to transform into a more consumer-driven economy, but its growth is slowing. We forecast this year, this is pre-coronavirus forecast, so we forecast growth of 5.8% for 2020, and we'll talk about the coronavirus in a second, and in 2021, 5.5%. So the Chinese economy is continuing to slow. Now, this is a normal development for a country that has reached middle income status, that is no longer such a poor country. We forecast growth by the end of this decade in China probably to be at 4%, if not a little bit below. So this trend is going to continue going forward. This chart is a couple days old. The coronavirus outbreak now is, there are now more than 10,000 confirmed cases, and I believe it's 214 deaths. It's very hard to predict what's going to happen here. This is the Lunar New Year season in China, so it's a mass migration of people to their home villages and towns at the moment when they can do that. But this has the potential to be quite a major crisis. There are already more cases of the coronavirus than there were of SARS in 2003. The death rate is lower, fortunately. There were about 700 deaths from SARS in 2003. So far, I think the death rate is 213, 214 at the moment. But this has the potential to be a major crisis. Now, if you think about what happened to the Chinese economy in 2003, it lost about 3 percentage points of growth during the SARS crisis. But in 2003, the Chinese economy was growing much faster. It was relatively healthy at the time. Now the Chinese economy is growing slower. It has issues with the trade war. It has issues with rising debt levels. So this could have not just a major humanitarian impact, but it could also have a major economic impact. There are already some economists who are throwing numbers out like 2% growth this year, 3% growth this year. I think it's premature to say that. We just don't know where this is going. But if this virus continues to spread and if the death rate starts to rise substantially, this could have a major impact on the Chinese economy. And if it gets outside of China's borders, we've only seen very small numbers at the moment outside of China's borders. But if it does, it could have a huge impact on the economy this year. It bears watching very closely. The other big issue in China, which has been superseded in recent weeks by the coronavirus, is the issue of Hong Kong. If you've been watching the news, you know that since June, on weekends in Hong Kong, and even sometimes during the week, 1 million people at a time are taking to the street. It initially was a protest against an extradition bill, which would have allowed Hong Kong citizens to be extradited to China to stand trial for certain types of crimes. It's turned into a major pro-democracy protest in Hong Kong. And this has a number of impacts. First of all, it's caused a recession in Hong Kong, which is one of the most important economic centers in Asia. But it also it's forcing Beijing to make a very difficult decision. It can go in and crack down on the protest and take a heavy hand on it, but it will destroy Hong Kong's economy in the process. It will damage Hong Kong's reputation as an economic center irreparably. Or it can sit back and do nothing and hope that these protests peter out, which may actually happen because of this coronavirus crisis, that may actually result in these protests dying out. But if it doesn't, then China runs the risk that these protests spread to the mainland. They start spreading to Chinese cities. And if that happens, then it's a very difficult situation for Beijing to deal with. So it's a lose-lose situation at the moment for China and how to deal with the crisis in Hong Kong. So China's slowing, but a lot of people assume India will pick up the pace and India will grow and everything will be fine. Well, the Indian economy is doing quite poorly at the moment. We estimate it grew by about 5.3% last year, which is a terrible rate of growth for India, which is accustomed to growth rates of 7 or 8%. It in fact slowed to about 4.5% in the middle part of last year. A number of factors are behind this. It has not received much foreign investment. The government has enacted some economic policies, whether it be taking 86% of the banknotes out of circulation or putting new restrictions on other parts of the industry, on other parts of the economy. This has all caused substantial slowdown in growth in India, which a lot of companies are banking on as being their #1 growth market going forward. And that chart you see there just reinforces what I said about foreign investment. India receives almost per capita some of the lowest levels of foreign investment in the world. When you consider this is a country with 1.4 billion people living in it, so 4 times the population of the United States, and it's receiving so little foreign investment. That suggests that there's a lot of uncertainty about India. And this works both ways. There's uncertainty about India's ability to be a safe place to invest, but at the same time, the Indian government is putting a lot of hurdles in place. If you've tried to do business in India, you know it's quite challenging. In China, when you invest, you go to Beijing and you get the approval and it's done. You go to India and you get the approval from Delhi, the state will tell you, go away, we don't want your investment. It's really challenging at the moment to do business in India, and this is reflected in these numbers here. The other key pillar of the Asian emerging markets is Southeast Asia, which I've talked about quite a bit. 660 million people living in these countries. You have some extremely fast-growing economies, places like Vietnam, the Philippines, Indonesia, all growing at least 5%. Vietnam growing by almost 7% at the moment. The Philippines by a little more than 6%. So some very high-growth markets in this region. And it's receiving a lot of foreign investment, particularly in the manufacturing sector. As China becomes more expensive, as investors and businesses become concerned about trade barriers with China, a lot of investment is shifting south. Vietnam has been a significant recipient of this manufacturing investment. Indonesia is picking up the pace in recent amount of infrastructure investment going into these countries right now with the hope that that will attract even more manufacturing investment ahead. And so far it's been bearing fruit, at least for Indonesia, at least for Vietnam and Malaysia at the moment. So that's Asia. We're seeing a lot of growth coming out of the emerging markets in Asia. Even as they slow even as they slow, they remain the key generators of growth. More than half of the world's additional economic output in 2020, barring a collapse because of the coronavirus in China, will come from Asia. And that's a trend that will continue for some time. So what about the rest of the world's emerging markets? One part of the world that's done pretty well recently is Central Europe. So that's Poland, the Czech Republic, Hungary, Slovenia, even Romania, those countries. They've done quite well. We've seen growth rates that are quite strong, despite the fact the population is declining in those countries. And we've seen wealth levels rise. You really can't call some of those countries emerging markets anymore. It's very to call the Czech Republic an emerging market and to call Portugal or Greece a developed economy really isn't fair, because the Czech Republic quite simply is much wealthier than those countries now. And that's a trend we've seen across Central Europe in recent years. Now, East Europe is a different story. Russia has been mired in a big slump since the oil price fell in 2014. It's recorded growth of about 1% per year since then, very little. Russia likes to project itself on a global stage as a great power, but its economy is anything but at the moment. And the same holds true for most of Russia's neighbors. So you have Central Europe doing very well. You have East Europe, which has been struggling and continues to struggle. And that just reinforces what I said about the rising wealth levels. Now, Russia had a surge in per capita GDP when the oil prices were high, but in recent years, we've seen almost no growth in that. But instead, we've seen growth in Hungary, Poland, and a number of other countries, which become increasingly wealthy. A region that struggled significantly in recent years and had a very difficult economic and political 2019 was the Middle East and North Africa. You're fully aware of the situation regarding the conflicts in the region. We also saw protests spread to countries like Algeria, Lebanon, Iraq. We've seen unrest rising in a number of parts of the region. The political challenges are well known. Problem is, the economic challenges are getting bigger and bigger. The longer the oil price stays low, relatively speaking, and it's been relatively low for 6 years now, the more the oil exporting economies in this region suffer. So if you were in Saudi Arabia or the United Arab Emirates and you were used to triple-digit oil prices until 2014, and your oil price was cut in half, you can imagine what that's done to government budgets. You can imagine what that's done to government spending. And you can imagine the impact that's had on the economy. The economy in this region grew by less than 1% last year. Keep in mind the population of this region is growing by more than 2% per year. So you can imagine what this is doing to wealth levels in the region. You can imagine what this is doing to people's moods in the region. And this is why we're seeing an increasing amount of anger in a number of Middle East and North African countries. I mentioned oil price. Despite the fact that we've seen attacks on Saudi oil installations and in the threat of a major conflict in the Gulf, oil prices continue to trend downwards. And the major reason for that is, as I mentioned, the United States. We are now producing so much oil and so much gas that there's very little fear about the supply of oil and gas in markets today. And when you look at demand levels not really growing much, you combine that with a lower supply side fear, and you get downwards pressure on the price of oil. And it looks like, barring a huge conflict in the Middle East, that will continue going forward, because we're not looking at substantial increases in demand for oil over the next couple of years, and we're looking at supply levels that have the potential to continue to go up substantially over the next couple of years. Another region that's been struggling in recent years is Sub-Saharan Africa. Now, for many, this is the long-term growth market. The population of Sub-Saharan Africa will grow by 1 billion people over the next generation, over the next 30 years. 1 billion additional people will live in Sub-Saharan Africa. So many parts of the world are dealing with labor shortages and falling working age populations. This region has a soaring working age population and tons of potential workers. But can the region create the jobs? That is the big question. We've seen investment in the region grow in recent decades, but in recent years that investment has stagnated. China and India had been investing heavily in this region, but they've scaled back to some degree their investments. And it remains to be seen if we're going to see a pickup, because, again, oil prices and other commodity prices have been low. The impetus to invest in this region has declined. And that's a major risk going forward. We're going to see population growth continue going forward. We need to generate wealth. We need to generate jobs. And can we do that? We can't do that when the economy of Sub-Saharan Africa is growing by just 3% per year. This is an economy that needs to grow at 5, 6, 7% per year to generate those jobs and create the wealth that the region needs. And what is one of the big problems in the region? There are success stories. There are many success stories in Sub-Saharan Africa. Countries like Ethiopia, which is doing tremendously well, Ghana, Cote d'Ivoire. There's a number, but the big economies, there are three major economies in the region right now: Nigeria and Angola, which are oil-producing countries who have been hit hard by the fall in oil price, and South Africa, which has been the most developed economy in the region, which has been struggling tremendously in recent years. Those three economies, they're barely growing at all right now. So the big economies are letting down the region, and we've seen that really hold down growth in sub-Saharan Africa. And I mentioned population growth, 1 billion extra people, a huge increase in the number of working age people in that region going forward. So finally, the region that's performed the worst in recent years has been Latin America. Over the last 6 years, it's barely grown at all. And again, it's the major economies of Latin America which are holding the region down. Brazil just came out of a recession where it shrank 10%. Argentina is currently in a recession. Mexico is right now not generating any growth. And Venezuela's economy is in complete free fall. And in fact, you see that reflected there by economic growth rates by region. Latin America has been the least successful region in recent years. There's a number of reasons for this. Again, low commodity prices have a big impact. The other thing is a lack of economic competitiveness. A lot of businesses are simply saying, we would rather source products for this region from China, from Vietnam, or maybe from the United States, than to build factories in Brazil or Argentina or other countries in the region. And that's something this region needs to tackle urgently if it's going to generate growth in the year. So that was a trip around the world like we always do. What are some of the key points you should take away? Well, that chart shows where the growth will be coming from this year. Now, assuming the Chinese economy grows at 5.8%, and that because of this coronavirus outbreak is a big assumption at the moment. Assuming it does, about 32% of the world's additional economic growth will come from China this year. Now, just a few years ago, this chart would have shown the United States and China both accounting for about a quarter of additional output. But even as the Chinese economy slows, as it gets bigger, its share of additional global economic growth grows. The United States will account for about 17% of additional growth. This is on an assumption of 2% growth in 2020. That's still relatively substantial. India will account for about 8%. And the EU, and that's minus the UK now because I've already kicked them out, will account for about 6%. So the growth markets haven't really changed that much, except that China is, of course, an ever more important driver of growth for the global economy. So you can understand when there's uncertainty over something like the coronavirus, just what that means for your business when your potential growth is coming from a single market like China. Over the next 25 years, the structure of the global economy won't change that much. I mean, your biggest economies now will largely be your biggest economies in 25 years. India will be the notable exception, even as India's economy has been disappointing. Just the scale of the country, 1.4 billion people, to rise to 1.7 billion in the next couple decades means that it will become an ever more important part of the global economy. And some other emerging markets will find their way up the list, but at a relatively slow pace. So what should you take away from this presentation? We are headed for our second consecutive year of below average economic growth. 2019 was the first. 2020 will be the second. We're not forecasting a hard landing for any major economies at the moment, but we are forecasting relatively sluggish growth this year. It's becoming harder for the rich world to generate growth unless we can improve the productivity situation in the United States and Europe and Japan and elsewhere. It's going to be hard to even generate 2% growth in the decades ahead. That's a major challenge going forward. Emerging markets are going to continue to be divided between the haves and the have-nots. The haves are those that are competitive, that have made their economies competitive, or just happen to be located in Asia, which is the main growth market. The have-nots are those that are not competitive or poorly located geographically. That split between those two is likely to grow in the years ahead. And finally, geopolitical and economic risk levels are going to remain high. They've been relatively high of late. They will remain high for the foreseeable future. There is a lot of upside risk in a number of parts of the world and a number of industries, and that bears watching going forward. There are a lot of issues that are in flux right now, whether it be the coronavirus, whether it be Brexit, whether it be trade disputes, that have the potential to cause significant harm to the global economy going forward. So that's all from me. If you think of questions or something after the fact, that's my email address. Please write it down or visit our website there, and I'd be happy to answer anything.